So you've probably read some of the same articles I have, which tell us that about 7 out of 10 people in the independent insurance industry are planning or at least age eligible to retire in the next 10 years or so. Maybe you're one of those, but as an agency owner, retirement's a little more complicated for you than it is for some of your employees. So I'd like to talk today and in a couple of succeeding videos about planning for succession, planning for your successful and profitable exit from your independent insurance agency. So to begin with, let's talk about some of the things that you need to think about as you contemplate your exit. And by the way, you may be 10 or 15 years away from that day. This is not too early to begin thinking about it. Conversely, you may be thinking about leaving next month. Well, you've got a lot of work to do. So, the first thing I want you to think about is valuations of insurance agencies have never been higher. Many insurance agencies are now selling for 3 times. In fact, we had one agency sell this year for 6 times revenue, somewhere between 10 and 15 times EBITDA. The reasons for that are really pretty simple, and it's low interest rates. Low interest rates make it more affordable for folks to buy an insurance agency, but it also means that investors have a tougher time making adequate returns on their investment, and so businesses like insurance agencies that have predictable, consistent cash flow have never been more valuable. The good news is that that low interest rate environment is going to last for a few years. The Federal Reserve has indicated that even if we see inflation in the next couple of years, they intend to keep interest rates low. So valuations of agencies should be high for the next few years, something to think about as you plan your potential exit. So one of the downsides or one of the consequences of low interest rate and high demand is that the supplies are actually lower than they've ever been before. One insider in the M&A industry told me that there's only about a 4-year supply of investment-grade insurance agencies available in the marketplace today. That low supply factors into the basic law of supply and demand in economics, which means that your agency has likely never been worth more than it is now. But there are some risks to think about. The first one is that the COVID economic disruption is going to have an impact on many insurance agencies as they lose customers or lose premium and commission due to customers shrinking because of COVID. And it's likely that those conditions are going to last into 2021 and potentially as long as 2024 or 2025. So if you're thinking about an exit in the next few years, you need to bear that in mind and make sure you're doing everything you can to maintain and grow your income, because that obviously leads directly to your value. One of the other things that you really should give some thought to is the composition of your staff. As agency owners get older, so do their long-term employees. And when someone is looking to buy your agency, they don't want to face the fact that all of you might walk out the door a year or two after the acquisition closes. So while you have time, this is the time to make sure that you have an adequate spread of age inside the agency. This will add to your agency value, and it's something that takes time to prepare for, so I wanted to mention it right up front. So, speaking of time and preparation, bear in mind that in the ideal circumstance, it's great to have 3 to 5 years before you're ready to sell the agency. Why? Because to do it well takes time to plan. And listen, I don't know about you, but for me, my agency is the largest asset on my personal financial statement. It is for most entrepreneurs, and this is a once-in-a-lifetime opportunity to cash in that nest egg you've been building for 20, 30, or perhaps 40 or more years. Let's talk about the things you need to do. First of all, you need to do some financial planning. I'll talk more about that in another video, but you're going to want to make some changes to the way your business is structured, at least on your profit and loss and balance sheet, to maximize your value. Another thing you're going to want to do is think about your staffing. Staffing has a couple of components to it. One is to be sure that you're not overstaffed, because those are profit leaks that will cause you to get less money for your agency, but the buyer's going to make those adjustments after the sale anyway. So you need to think through that. The other thing is, what are you paying folks? And one of the things that many agencies do is they overpay producers. Acquirers are going to pay about 30%, maybe 35% for production. So if you're paying producers more than that, you're going to want to begin to think about how you can reduce that expense to maximize your profitability and therefore your value. This takes time, and so think about staffing. Another thing to really give some thought to is who's your buyer. Now, it may be easy, and it may be a son, daughter, or other family member, and this is going to be an easy transition. Great. But if it's not, is it a key employee? And if so, how do you help them prepare not only for the money they're going to need to buy you out, but also the management experience they're going to need to make sure they keep the thing running the way you do now in the future? Or is it a local insurance agent? Have you identified someone or perhaps several someones who could be your buyer? If you haven't, and that's your goal to sell locally, now's the time to begin to think about who that might be. The last major category of potential buyer for your agency would either be a national broker or a PE firm. PE stands for private equity, and private equity are not only some of the biggest buyers in the industry now, but they're also some of the ones that pay the most money. But anyway, that's another type of buyer you may want to consider. If you're going to consider a national broker or a PE firm, it's going to have implications for how you prepare for the sale, which I'll talk about in another video. So, how long does the transition from agency owner to former agency owner take? You need to understand that many deals are structured with what's called an earnout. In other words, you don't get all of the money up front. You're going to earn some of it after the sale. And that usually means that you need to stick around for a few years. Typically, that's somewhere between 2 and 4 years, with 3 being average. So, back to getting ready and preparing, and how far in advance is ideal. Well, it could be as much as 10 years, because maybe it's 3 or 4 years from now that the business goes on the market, and it's a year to get a deal consummated, and then you stick around for 3 or 4 years. Well, there's a decade. So it's never too early to get started planning. And the only thing you need to understand is you can do that. You're just not going to get as much money for it. I'll talk more about that in another video. Thanks.